That One Future CPA podcast is produced by Beyond the Balance Media. Picture a Jenga tower. The top looks just fine, maybe even taller than before. But look closely and you can see the spaces where blocks used to be. This is the US economy in 2025. We've built record market valuation and luxury demand on top of a foundation that's thinning out. The top keeps stacking higher, stock prices, wealth concentration, and corporate profits, while the bottom layers, the everyday spenders who used to stabilize this structure, are disappearing from underneath. Economist Peter Atwater, who coined the term K-shaped recovery, called this new phase the Jenga economy. It's the same inequality curve, but with gravity built in. This structure is incredibly uneven and it is unstable. This is That One Future CPA podcast. My name is Christopher Dickerson. This episode isn't about market panic or political debate. It's really more about structure, how an economy can keep growing while its base erodes, and what that means for anyone trained to read systems, risks, and balance sheets. The Jenga metaphor works because it is visual. You remove blocks from the bottom to make the top taller. That's what we've done for decades. Pulled out wage growth, affordable housing, public safety nets, and broad-based credit, all to support the illusion of height. Today, we'll walk through which blocks have been removed: wages, credit, housing, fiscal support, and corporate balance, and how these missing pieces are quietly shaping the next downturn. And we're going to start with the numbers. The top 10% of the U.S. households now account for nearly 50% of all consumer spending. The bottom 80% share has dropped from 42% before the pandemic to around 37% today. This shift matters more than GDP or job counts because consumer spending isn't just a headline number, it is the stabilizing layer in our economy that absorbs shocks. When the base contracts, every layer above it becomes more sensitive to change, and that is exactly what is happening right now. In a Jenga tower, height looks impressive right up until it isn't. Growth on top of imbalance is still simply imbalance. The first block that was removed was wage growth. For most workers, inflation has outpaced earnings since mid-2022. Nominal raises have been swallowed up by higher costs for rent, food, energy, just about everything. The gains that remain are uneven, strong for high-skilled professionals, weak for service and production roles. And we have been talking about wage growth and the labor market on this podcast since last season. And the real income growth, the money that's left after costs, is negative for much of the lower and middle income ranges. These households are struggling in a way that they've never struggled before. From an accounting perspective, this is a recurring loss. Disposable income is the first line on a national income statement. When it contracts, every business downstream sees a margin squeeze. The income statement still shows revenue, however, that cash flow underneath it is weakened. Corporations have compensated through pricing power, but pricing power isn't infinite. It's just deferred elasticity. The moment when demand finally breaks. In this Jenga tower economy we have, wage erosion is the missing cornerstone. It is the block that carries the most amount of weight. And we know this. We know that corporations are able to control their bottom lines in ways that are more outsized when they're able to impact the labor market, when they're able to cut jobs, when they're able to suppress wages, right? And so we have seen time and time again the way corporations have used the levers of wage and labor, right, to account for weakening margins and revenue. Let's move on to the second block here, which is sustainable credit. And what do I mean by this? Consumer debt has passed $17 trillion. $17 trillion, which is a number your mind and my mind cannot really comprehend. Credit card balances have hit all-time highs this year. Delinquency rates are rising faster among borrowers under 40 who tend to be more middle and lower income earners and are impacted the most by where our economy is today. In the language of accounting, households are recognizing revenue they haven't yet earned. They're front loading their consumption based on future income that may never arise. This is exactly what credit is, right? You're deferring some of this revenue, right? You're spending money simply that you do not have in hopes that that money will come in the future, and that is precarious. The timing mismatch works in good times, right? But structurally, it mirrors a business with aggressive revenue recognition, one that records sales before collectability is assured. When the collections come due, you don't have just lower income, you have a bad debt expense, right? So that credit card debt becomes not only lost revenue that you thought you were going to have, but it becomes bad debt expense that now you have to pay interest on. And we know where interest rates are now. At the household level, that bad debt shows up as defaults. At the macro level, it becomes contraction, right? This block was the economy's working capital. We'll call it that, right? So this was basically what was helping the economy move forward in real cash terms. It's been completely hollowed out. This is the second block, but it is incredibly important, and it plays right hand in hand with that wage erosion from that first block that we spoke about. The third block removed was accessible housing. And I do not have to expound on accessible housing. I could, of course, have a whole mini-series. We might have a whole mini-series on why housing is so expensive, how housing became so expensive, why it continues to be so expensive, and what this means for generations who dream to be homeowners in the coming years. So again, the third block removed was accessible housing. So let's break it down. Mortgage rates remain above 7%. Home affordability is at its lowest point in 40 years. I saw a graphic on CNBC that said the average age for a first-time homebuyer was 40 years old, and the average age for a repeat homebuyer in America was 60 years old. This is economically unstable. We cannot sustain this. Apparently in the 80s, 89 when I was born, it was like 33. So the erosion and the ability of younger people in this country to purchase homes, right, is plain in our faces, and it should be a red flag, a flashing indicator for our economic leaders. Let's dig in a little bit further, right? Institutional investors now own a growing share of single-family rentals, and starter homes have become an investment vehicle, not an entry point. I used to sell real estate. I'm shocked by the amount of institutional investors that own single-family homes in cities like Atlanta, Chicago, Charlotte, and Austin. It is completely removing the ability of first-time home buyers to buy an affordable starter home because it's owned by Blackstone or by Invitation Homes or by Progress. Okay? For the middle class, home equity used to serve as both savings and collateral. It was the base layer of wealth creation, the one asset that compounded while people slept. There's so many stories of, I don't want to say the word boomer because it has kind of like a negative connotation, but of our older generational friends buying homes for $30,000 when they got out of college, and the house being worth $700,000 now, right? This is the type of quiet appreciation that middle class earners in America could almost always depend upon. However, without that, the stabilizing function disappears. Households can no longer refinance to smooth consumption or borrow against appreciation to fund small businesses or education. I know lots of people who take out home equity loans to open up small businesses or to send their children to college. The erosion, right, of people's ability to own a home and realize the appreciation in that home and then transfer that into other meaningful ways to consume in our economy is dangerous. It's unsustainable. This should be a red flag. America should make it as easy as possible for people to make money, appreciate their assets, open businesses, go to college. These things should be simple, and they no longer are. So that loss does not show up in our income statements, right? It shows up as volatility. A base without equity is a base without resilience. And this is what home ownership is, or the lack of it in our country right now is a base without equity, without resilience, right? It's unsustainable. I keep saying that. It's unsustainable. This block right? Affordable housing removed the self-correcting mechanism that used to catch the tower before it tilted too far, right? Still using our Jenga analogy, right? This block is not only incredibly important like all the other ones are, but it helped to sort of handle some of those shocks, like the consumer section of our economy. Without affordable housing, without accessible housing, without that quiet appreciation, we are easily seeing the erosion of the middle class. The fourth block removed was fiscal support, the public cushion. Pandemic era transfers, that's hard to say, pandemic era transfers like stimulus checks, child tax credits, and student loan pauses temporarily rebuilt this base. They replaced private income with public outlays. When those expired, the economy lost both the cushion and the illusion. So both the illusion that lower income and middle income earners were able to consume at these rates that the higher part of our economy was, but also the cushion that existed there. And a lot of people will make comments about the amount of government transfers that occurred during the pandemic, but I mean, it's pretty once in a 500 year, once in a million type event. I don't think there was a playbook for that, but certainly it did create the illusion of a more equal economy. But now that a lot of that stimulus has dried up, a lot of those pandemic era transfers have ceased, we're starting to see the real economy. State and federal governments are now tightening their budgets. I mean, the federal government's pullback of spending absolutely will show up next year. It hasn't really flowed through the economy just yet, but certainly you cannot get rid of hundreds of thousands of federal workers. You cannot cut federal spending by billions of dollars and not have a trickle-down effect on the economy. Temporary aid programs have sunset. We were talking about pandemic-era programs that are just simply gone. The automatic stabilizers that used to expand during these downturns, like unemployment benefits, food assistance. We are talking on November 7th, 2025, which is in the middle of the longest federal shutdown in American history. So certainly people are being impacted in ways during the shutdown, but even outside of the shutdown, with the pullback of unemployment benefits, food assistance, and tax credits that have been weakened or simply capped or completely wiped away. In fiscal accounting, right? So from an accounting standpoint, that's a retraction on counter-cyclical entries. The system that once offset private sector contraction now amplifies it. What this means is that for households, there's no safety margin. There's no margin left. There's no safety net left to fill some of these gaps. And for policymakers, it means that every shock travels even farther. That's the thing I don't really understand by pulling back on some of these safety net programs is it just deepens the economic shock. And of course, America being like a 70% consumer economy, every type of economic shock that is felt by lower income and middle income earners is going to be that much stickier, especially, again, without that fiscal support. Now, we're talking in accounting terms. This block, this fiscal support, this public cushion was our reserve account, right? Our allowance for doubtful accounts, a little extra money, a little cushion that we had, this one that balanced the books when everything else failed, and now it is gone. And American families could tell you, especially today, November 7th, 2025, November 7th, 2025, they could tell you absolutely the way they are struggling with rising insurance premiums, gaps in food assistance, and all of the other things that happen when there is a gap between what can be done and the public support for people who really need it. And this kind of moves directly into our fifth block, right, which is corporate behavior. I spoke about this on season 1 of that One Future CPA podcast when we talked about the shareholder primacy idea that has permeated corporate America and how corporations are not moving in the way that might be altruistic for society and is more about wringing out every bit of revenue as they can. So again, that fifth block was balance in corporate strategy. So what does that mean? Companies have shifted their focus towards premium segments. They're chasing margin at the top instead of volume at the base. Margin at the top instead of volume at the base, meaning They're thinking, I'm just going to sell something very expensive that I can, get a wide margin on, rather than trying to sell something that might not make me as much money, but I'm selling it at a cheaper price so that lower middle income earners are buying it, who make up the largest amount of the economy. And so I'm winning on volume. Our portions are smaller. I mean, my God, I literally just saw, I saw a video on Twitter this morning or yesterday about shrinkflation. Shrinkflation is so funny because it's so obvious. I mean, it's all around us. It's happening all the time. So portions are getting smaller, prices are getting higher, and marketing language is full of things like luxury or pro or plus. Every app, every website, every subscription package has a pro and a plus, and I'm searching for apartments in Chicago now for my move after graduation, and every apartment's luxury, every gym is luxury, every Uber X luxury. It's just like, why is that happening? It's because those margins exist when you're pricing it. I mean, an Uber X, for Uber, there's no difference between an Uber and an Uber X and Uber XL. The only difference is the perception of the customer, and they're able to get margin from that, offering exactly the same service, right? It's something called mix shift, right? That's what a CFO would call this, like a mix shift. You're shifting the mix of your products. Analysts might call it margin optimization. The funny thing about being in accounting, I'm sorry, that was an uncontrolled laugh. The thing that's funny about being in accounting is you hear something like margin optimization, and you're like, okay, that's just whatever. Someone just got paid $175,000 to call it that. Economists might call this concentration. I think that's probably the most apt term for what's happening is concentration, because you really are focusing on one segment of the market, betting all your bucks up there, because it works until everyone does it. Right? When every firm chases the same income consumer, high income consumer, the tower narrows, right? Demand looks stable because it's compressed into the top, but that slightest change, if we just have a little bit of a stock market pullback, right? If we have a bonus freeze, if we have a corporate profit slowdown, if we have a luxury slowdown, right? This is going to hurt the entire tower, right? It's going to cascade down to the base in ways that could be disastrous. This corporate behavior block, right, is really our diversification. It's been replaced by dependence. So again, companies are not worried about how can I create the most products for the most amount of people, right? They're more thinking about, hey, I need these high income customers, and how can I make sure I'm offering them products that are able to satisfy what they need and expand my margins, and maybe the lower income customers will come back at some time. I don't know if that's sustainable. I think that most successful companies have a wider array of products that apply to different levels of income. And I don't know if only working the top market works. I mean, look at Apple. Look at cell phones. For the longest time, cell phones were really about premium, and then almost every cell phone carrier has an array of products that are addressing different income levels in the market. So again, I don't think that it's a sustainable corporate strategy to only focus on higher income customers in hopes of chasing margin optimization. So in accounting terms, this concentration risk is designed as profitability. It really is concentration risk, and it is quite obvious that a lot of companies are hoping that maybe that lower part of the Jenga tower strengthens up and they're going to survive off these higher income consumers for now. I'm not sure if that is the most apt or the most successful thesis to lean upon. So what does this mean? If we put all the missing blocks together, right, the picture gets much sharper. The tower still stands because the top is incredibly strong, right? There is incredible wealth creation happening at the top of this Jenga tower, at the top of the income levels in America. The stock market is booming. If you own assets in the stock market, if you own a home, you're definitely seeing some wealth creation and appreciation. The asset markets, in my opinion, are inflated. Corporate profits are near record high. Wealth effects are intact, right? It's very Great Gatsby, very let the good times roll out there right now. But every removed block adds volatility to the structure. And we just talked about 5 incredibly important blocks that have been removed from this Jenga tower structure that are now making us feel a little bit more wobbly from the top. Americans have built an economy where stability depends on a small group of big spenders. When they slow down, and they will because they cannot spend at this level forever, when they slow down, there is no broad base left to catch the fall. This is why this is concentration risk. Because if your mix shift has moved into the luxury space and only into the luxury space when that space weakens, what do? It's almost like Vegas. Think about it. Vegas is almost exclusively like a luxury high roller place. I mean, I saw a newscast 2 days ago where the Vegas reporter was saying 2 cheeseburgers, not double cheeseburgers, no bacon, no cheese, just 2 cheeseburgers on the strip for $60. So if you're Vegas, if you're those casinos, I believe the luxury market has sort of fallen out. One, because I think that people think it's not as cool anymore. Maybe it's a safety issue. I don't really know, but it's clear that something is happening there. And certainly middle and lower income travelers and earners are not going to Vegas anymore because it is incredibly expensive. I mean, I spent a couple of days there with my brother just a few years ago, and it was like $1,000 for 4 days in a room, and it was at one of the older casinos on the strip. So you could just imagine. So there is danger that if something was to happen to those upper echelon earners, that our economy would not be able to handle that shock because the bottom has been hollowed out. It's sort of the same pattern that preceded earlier collapses: the 2008 housing leverage crash, the 2000s tech bubble, the 1929 credit expansion. And we're actually launching a series here soon called Bubble Watch, which is a 5-episode mini-series talking about how we're currently living through what may look like an AI bubble that has been, it looks like very close to some of the other bubbles we see out there. So we're seeing some of the same behavior happening in these little pockets of the economy that if they start to converge, we'll have a mess on our hands. We will absolutely have a mess in our hands. And so in this case, the numbers were correct. The story around them just wasn't during these bubbles. And so we have to look at what's happening right now with those eyes towards the past and a lens towards what's actually really happening here. Because for accountants, analysts, and valuation professionals, the Jenga economy, it's not a metaphor, it actually exists. It's a test of how we interpret what I've been calling concentration risk and sustainability. And both of these things are at play here when you're talking about this mix shift or margin optimization, because you're concentrating all of your selling into one income group, concentration risk, and certainly that's not sustainable. So that's a business sustainability question as well. So as accountants, we've been taught to separate core earnings from non-recurring items, to question whether growth is supported by cash flow or policy. We should be looking at that. To identify, as accountants, we've been asked to identify when temporary inflows mask structural weakness. That's what's happening right now in the economy. So the same lens applies here. Let's break this down. Stay with me. When half of all spending comes from the top 10%, that's concentration risk. When wages stagnate while asset values climb, that's an income statement illusion. When credit props up consumption, that's deferred recognition. When fiscal support disappears, that's liquidity risk without disclosure. These are very common accounting issues that when we apply this to the U.S. economy, it becomes clear that we have an issue on our hands. Again, I'm not a politician. This is not a political podcast. These are not political statements. I'm just making observations like an auditor. These are audit observations that I see when looking at the economy, and I'm not blaming one party or the other, one administration or the other. These are structural issues that certainly predate our modern presidents, and in fact predate myself. The Jenga economy is what happens when you build macro performance on temporary accounts. I don't want to sound like I think something bad is going to happen. What I'm really saying here is that our eyes should be open because the concentration risk is very clear. The risk of sustainability is right here in front of our eyes. So exactly what do we do? Like, what's the policy? Like, how do we move forward on this issue? And if the tower is going to stand, the base has to be rebuilt. This means reconnecting productivity and pay. Reconnecting productivity and pay. expanding access to affordable credit that doesn't depend on subprime risk, restoring fiscal tools that respond automatically to downturns. I want to articulate that. These things are what we need to rebuild the base of this tower to ensure a healthy economy for all of us. Because policy should not act like internal controls, right? Preventing concentration before it becomes systemic. They should act like that. Policy should act like an internal control, right? It should be preventing concentration before it becomes systemic. There's systemic risk in our economy right now. And as a child of 2008, that word systemic risk is very scary because I remember hearing that in 2007, not seeing anything happen, and then seeing the economy blow up in front of our eyes. At the corporate level, the same principle holds, right? Diversify your customer base, align pricing with real demand. Stop assuming the premium segment will stay insulated. McDonald's, Chipotle, Cava. These places are making it very clear that lower and middle income households are not spending like they used to. And I promise you, higher income households will not be able to sustain McDonald's and Cava and Chick-fil-A for years to come. The rebuilding of America's low and middle income base has to be a priority, or our economy as we know it will cease to exist. And I'll leave with this. Growth isn't just about adding height to the tower, right? We're not trying to make our Jenga tower as tall as possible. It's about widening the foundation, which makes it stronger to absorb any upcoming shocks. And again, I don't think that's political to say that a stronger lower and middle income base makes a stronger economy for everyone. I think that's pretty clear. I think the question is, what do we do to get there? And I'll close with this. You can't ever win at Jenga, right? It's not a game where you win or lose. You really just only delay the fall. Every block that's pulled from the base makes the tower taller. However, it also makes the tower more fragile. Every shortcut you take, right? Wage suppression, credit dependence, fiscal withdrawal, buys time at the cost of stability. The U.S. economy is far from collapsing. However, it is teetering. It is leaning a bit. And when it leans long enough, that correction always looks sudden. The question isn't whether the tower will fall, it's whether we rebuild that base before it does. I really like this conversation because it really does blend accounting, people, power, policy, right? Our tagline here at Beyond the Balance Media. So I literally wrote this today. I literally wrote this on the 7th because I was like, no, this is something that has to be spoken about because I don't think people are really understanding what's going on out there, right? This Jenga tower metaphor is very apt for the moment because it really does highlight what's happening in our economy. It's actually kind of crazy. So, however, next time, as I alluded earlier, we're launching a new mini-series. So excited about this. We're launching a mini-series called Bubble Watch, which are short episodes that track the sectors where optimism is inflating faster than the math behind it, right? Creating that bubble. Because if the Jenga economy has taught us anything, it's that every bubble starts with someone calling imbalance innovation. And so our Bubble Watch episodes are really focused on AI and the bubble, and I totally believe it's a bubble that's forming and what that means. But again, we are on Spotify, Apple Podcasts, we are on YouTube, we're now on Amazon Music, which is cool. We're on YouTube, we're on Substack, so please like, watch, listen, share wherever you can. And again, for our next series that's launching for Bubble Watch, check the same feed. It'll be right here with you, but it will be shorter episodes, really just sort of talking about AI and what that bubble looks like. But again, this is That One Future CPA podcast. I'm Christopher Dion Dickerson, and thank you for joining.